Welcome to the Deep Dive. Today we're cutting through some of the noise around economic uncertainty. We want to focus on something really practical. Building investments that, well, actually provide reliable income.
Yeah, and for ages, gold has been pushed as the ultimate safe harbor, the classic store of value, the hedge against inflation.
Exactly. That historical view is strong. It feels tangible, comforting almost when things seem rocky.
It really does. But we're shifting gears a bit today, aren't we?
We are. We're going to make the case that maybe relying too heavily on gold isn't the best play, especially if what you really need is consistent income coming in.
Right. Income generation. That's the key focus.
So our deep dive today is all about exploring 3 specific and I think more dynamic ways to build an income-producing portfolio. Moving beyond, as one source nicely put it, the shiny but ultimately unproductive nature of gold for income investors.
Precisely. I mean, look, gold might have a tiny role, maybe, in some super diversified strategies, but fundamentally, it doesn't pay you anything, and that lack of cash flow makes it less appealing if you're building for the long haul and need money coming in.
Okay, let's get into these alternatives then.
Yeah.
We said 3 areas: dividend growth stocks, high-quality REITs, and covered call ETFs.
Oh, sounds good.
Let's start with dividend growth stocks. One source called them a key tool, kind of like a secret weapon for building wealth. What exactly are we talking about here?
Okay, so dividend growth stocks are basically shares in companies that not only pay you a dividend, but they have a history of increasing that dividend payment year after year, ideally.
Ah, okay. So it's like getting a raise on your investment income gradually over time.
Exactly like a raise, which is pretty appealing, right?
Yeah, income that actually grows. What makes this so compelling, though? What are the big benefits?
Well, there are a few key things. First off, those growing dividends. They can be a real weapon against inflation. You know, the research points out like a $100 dividend today might become $105 next year, then $110. It helps your income keep up or even beat rising costs.
That makes sense. Keeping pace?
And second, that consistent history of increasing dividends. It usually signals that the company underneath is financially strong, it's got durable earnings, these aren't, fly-by-night operations, they can afford to keep paying and increasing.
So a sign of quality and resilience.
Definitely. And maybe the most interesting part, historically, these types of companies, the dividend growers, they've often delivered really strong total returns, and sometimes with less up and down volatility compared to other parts of the market.
Less drama and strong returns. Okay,
Wow.
yeah, that sounds like a good combo. Can we look at some examples? Did the material mention specific companies?
Oh, yeah, absolutely. PepsiCo, ticker PEP, is a classic. Over 50 years of consecutive dividend increases. Just think about that.
50 years. Wow.
Yeah. And the thinking there, as the analysis suggests, is, well, people tend to always buy snacks and drinks, right? It's pretty stable demand. Good brands, pricing power.
True. Stress probably increases snack consumption, if anything.
Yeah, maybe so. Then you've got Microsoft, MSFT. You might not immediately think dividends, but it's actually become this quiet dividend growth monster, just massive, consistent cash flows fueling it.
Interesting. Not the first name that springs to mind for dividends, yeah.
And Home Depot, HD, the material calls it, America's home improvement darling. Just a really solid performer over time in that sector.
Okay, those are big established games. Makes sense. If someone's looking into these, is there a key metric, like a pro tip from the research?
Yes, a good practical tip was to look at the payout ratio. Ideally, look for companies with payout ratios under, say, 70%.
Payout ratio.
Yeah.
That's the percentage of earnings paid out as dividends.
Exactly. If it's below 70%, it suggests the company isn't stretching too thin. It has room left over to, reinvest in the business and keep raising that dividend in the future. It provides a cushion.
Got it. Ensures sustainability.
Yeah.
Okay, good tip. Let's shift to number 2 then. High-quality REITs. Now, REITs, real estate investment trusts. For anyone who's actually been a landlord, the idea of real estate income might bring up some headaches.
Yeah, tenants, toilets, and trash.
Well,
Right. REITs offer a different route.
how so?
Well, REITs let you invest in real estate and get income from it, but without being the direct property manager. These are companies that own and usually operate income-producing properties. Think apartment buildings, shopping centers, warehouses, data centers, big stuff.
Ah, okay. So you own a piece of the company that owns the buildings. Indirect real estate investing.
You got it. And you get exposure to all that rental income, hopefully, without the late-night calls about leaky pipes.
That sounds appealing. What makes them specifically good for income seekers, though?
Well, a really key thing about REITs is their legal structure. By law, they have to distribute at least 90% of their taxable income back to shareholders as dividend.
90%?
Like,
Okay, wow. That's a high bar.
it is. It basically forces them to be these consistent income generators, as the research calls them. So you often get pretty attractive dividend yields, plus the potential for the property values themselves to go up over time.
Consistent income generators.
Yeah.
I like the sound of that. Any specific examples of high-quality ones mentioned?
Sure. Realty income ticker O is a really famous one. They actually call themselves the monthly dividend company.
Monthly. Okay, that's different. Most dividends are quarterly, right?
Yeah, most are. So getting that check every month can be really appealing for budgeting, Very predictable. Then there's Prologis, PLD. They're huge in industrial real estate warehouses, logistics centers. Think the whole e-commerce, Amazon economy infrastructure.
Right, the backbone of online shopping.
Mhm.
Makes sense.
And public storage, PSA. The analysis had a slightly funny but true point. People kind of never stop needing places to store their extra stuff. So self-storage can be surprisingly resilient and profitable.
True enough. We all have too much junk. Okay, so these sound good, but any warnings or things to watch out for with REITs?
Yeah, definitely. The research stresses focusing on REITs with strong balance sheets. That means looking at their debt levels. You don't want them overloaded with debt relative to their assets.
Okay, low debt is good. What else?
High occupancy rates. You want to see that their properties are actually leased out and generating rent consistently. And, it's generally smart to avoid the really speculative corners of the REIT market. Some might promise super high yields, but they could come with a lot more risk. Stick to quality.
Check the balance sheet, check occupancy, avoid the risky bets. Got it.
Yeah.
Valuable advice. Okay, strategy number 3. This one sounds like it might have a bit more spice. Covered call ETFs.
Yeah. Potentially higher yields here, but the mechanism is a little more complex. Definitely for those comfortable with a bit more going on under the hood.
Okay, break it down for us,
Mm-hmm.
especially for those like me who aren't, options trading wizards.
Right. So covered call ETFs are basically designed to generate income from stock market volatility. How? Well, the fund manager holds a portfolio of stocks, say stocks in the S&P 500 or NASDAQ 100.
Okay, holds the stocks.
And then they sell call options on those stocks they hold. A call option gives someone else the right, but not the obligation, to buy the stock at a certain price by a certain date.
Okay.
The fund collects money a premium for selling that option, and that premium income is basically what gets passed along to you, the ETF shareholder, usually as a monthly distribution.
So the income comes from selling those options, fueled by the potential stock price movements.
Exactly. And this strategy can lead to those higher yields the research mentions, sometimes in the 7% to 12% annual range, though it varies.
That's a pretty high potential yield.
It can be. And the beauty of the ETF structure is it's hands-off for you. You don't have to actually trade the options yourself, which, as the material kind of jokes, is probably a good thing for most individual investors. It can get complicated fast.
Definitely not something I'd want to manage myself. So the ETF does the heavy lifting.
Right. They manage the whole process. And that income from the options can also act as a bit of a cushion if the market dips slightly.
Interesting. What are some examples of these ETFs that were mentioned?
Let's see. The Global X NASDAQ 100 covered call ETF, ticker QYLD. That one focuses on the big tech stocks in the NASDAQ 100, but aims to generate that high income.
So a tech exposure, but with an income focus.
Kinda, yeah. Then there's JP Morgan Equity Premium Income ETF. That one's often noted for maybe having a bit lower volatility, still aiming for good income, professionally managed.
Okay.
And XYLD, that's one that does the same covered call strategy, but on the broader S&P 500 index, sort of the classic benchmark approach.
Got it. So different flavors depending on the underlying stocks. But what's the catch? They're usually a trade-off with higher yields, right?
Absolutely. The main trade-off with covered calls is you can cap your upside potential if the market really takes off, like in a strong bull run.
How so?
Because you sold that call option, remember? If the stock price shoots way up past the option's strike price, the fund might have to sell the stock or the gains get limited. You essentially trade away some of that potential big upside in exchange for the upfront option premium income.
Okay. So you might miss out on some big gains if stocks soar.
You might. But, as the research points out, if your main goal is generating income, getting that regular cash flow rather than capturing every single bit of potential growth, then that trade-off might be perfectly fine for you. It's about aligning the strategy with your goals.
That makes total sense. Focus on income, accept the potential growth cap. Okay, so we've got dividend growth stocks, REITs, covered call ETFs, 3 different tools. Do people need to, like, pick just one lane?
Oh, definitely not. Actually, the research makes a strong case for blending them. You can create a really robust sort of income ecosystem in your portfolio by using all 3.
An income ecosystem. I like that. How would that work?
Well, you could use the dividend growth stocks for that potential inflation-beating income growth and long-term appreciation. Then add REITs for that steady kind of rent-like income from tangible assets. And then maybe layer in some covered call ETFs to potentially boost the overall cash flow yield of the portfolio.
Diversifying your income streams within the portfolio itself? That's smart. Did the research suggest, like, a sample mix?
It did offer an example, yeah. Something like 40% in dividend growth stocks, 30% in high-quality REITs, and 30% in covered call ETFs.
Okay, 40, 30, 30.
But, that's just an illustration. Your own mix would totally depend on your risk tolerance, how long you're investing for, what your specific income needs are, all that personal stuff.
Right, got to tailor it.
And it also mentioned, which is a great point, that maybe when you're younger, you'd reinvest all those dividends to really power up the growth through compounding.
Let it snowball.
Exactly. And then later, maybe as you get closer to retirement or need the income, you flip the switch and start taking that cash flow out to live on.
Flexible. Okay, this is all great, very practical, but
Yeah.
I can still hear that little voice, the one whispering about gold. That historical allure is strong. We should probably tackle that head on.
Yeah, absolutely. It's natural. Gold has been around as money or a store of value for literally thousands of years. That reputation isn't easy to ignore.
So does it have any place? The research seemed a bit dismissive overall.
It was, for income purposes mainly. It did acknowledge that maybe a very small allocation, like 2%, maybe up to 5% max, could offer a tiny bit of diversification if you're really worried about, like, extreme tail risk events, super unlikely economic meltdowns.
Okay, so a tiny sliver for extreme scenarios, maybe. But beyond that.
Beyond that small just-in-case allocation, the argument for holding a lot of gold gets pretty weak, especially if your goal is income. Because fundamentally, what does gold do?
Well, it sits there and looks shiny.
Pretty much. It doesn't generate any cash flow. Zero. It doesn't pay you dividends. It doesn't collect rent. And its price can swing around quite a bit, too. It's purely dependent on someone else wanting to buy it for more later.
Right. As the analysis quipped, gold doesn't pay the mortgage, doesn't cover the gas bill.
Exactly. It's not functional income. Whereas these other strategies, owning dividend stocks, REITs, you're owning pieces of productive businesses or properties that are actually earning money and sharing some of it with you.
You're getting paid to wait, essentially.
You are. You get regular income. You benefit from compounding if you reinvest. You're building, like, real usable wealth you can tap into. Gold just sits there, hoping sentiment shifts its way.
That's a really clear contrast.
Yeah.
So thinking about someone listening now, maybe they like these income ideas, but they're hesitant. They feel like they need to wait for the perfect time to jump in. What's the message there?
Oh, that's such a common hurdle. Trying to time the market. The research was really clear on this. There's basically no such thing as a guaranteed perfect time to invest.
Why not?
Because markets always fluctuate. There's always something worrying in the news cycle, always uncertainty. If you wait for everything to look perfectly calm and clear, you'll likely be waiting forever.
And what's the cost of just waiting on the sidelines?
It's huge. It's the opportunity cost. While you're waiting, you're missing out on all those potential dividend payments piling up. That's income that could be growing, compounding, getting you closer to your goals, giving you more financial freedom.
Missed income, missed compounding.
Yeah. The research had a great closing line on this. The best time to start was yesterday. The second best time is today.
Love that. Stop waiting, start doing. Okay, so summing it all up, the big idea today is really to challenge that traditional heavy focus on gold, especially for income, and instead prioritize building a portfolio that actively works for you, generating cash flow through things like dividend growth stocks, REITs, and maybe some covered call ETFs.
Exactly. It's about shifting focus from a passive asset like gold to active income-producing assets, owning shares in real businesses, real properties that generate real earnings and share them with you. That consistent income stream can bring a lot more stability and peace of mind, especially when the wider economy feels uncertain.
Makes a lot of sense. So what's the final thought you want to leave our listeners with today?
I think it ties back to that last point. The research used a nice metaphor. Start planting your income tree today. Don't wait. By strategically putting your money into these kinds of income-generating assets, you're building something that can support you down the road, producing that steady flow of cash. Future you, as the article joked, might be too busy cashing checks to thank you properly.
Uh-huh. I like that image. Planting the income tree. So for everyone listening, maybe take a moment to really think about that. How could generating consistent income from your investments change how you feel about market ups and downs? How could it impact your long-term financial security? Definitely something worth digging into further.
Absolutely.
Thanks for joining us for this deep dive.